Good evening, students. Sorry for the delay. Actually, there was some technical issue. So today what we are going to start with is the transfer pricing class, and let's get quickly started with it. So first of all, let me tell you that why did we have the transfer pricing? It's not a very old concept, or it's not present since the inception of the Income Tax Act. It has been introduced not recently, I would say, but in 2000 only. So what was the need of having the transfer pricing in the Income Tax Act? So it was realized that because of globalization, the multinational enterprises or multinational companies are able to have the integrated operations amongst themselves. And they have a kind of a structure wherein many subsidiaries, parent and associate enterprises are involved. And they are operating in different countries through a web of structures, wherein they are having the intercompany transactions. Now, as you would be aware, that intercompany transactions can be priced at whatever rate the MNCs would like to have, right? Because these are intercompany transactions. So they can price these transactions at whichever rate they wanted. And by this way, they were actually
Recording in progress.
They were actually shifting the profits outside India. So therefore, there was a need felt of having the transfer pricing regulation under the Income Tax Act. Now, this transfer pricing regulation, what does it do? It is an anti-avoidance mechanism, anti-tax avoidance mechanism, a specific anti-avoidance regulation, SAR we can call it, which curbs these kind of profit shifting activities by the MNCs. So what does the transfer pricing do? The transfer pricing has introduced a principle called as arm's length principle or arm's length pricing, as you may see, ALP. Now, let's try and understand with the help of an example. Say, for example, there is AINC, a US company. This has a wholly owned subsidiary, say B Limited in India. Now, B Limited is purchasing the goods, or AINC is selling the goods to B Limited at, say, rupees 700. But if you notice the value of this product is not of 700. This is priced at 700. So rather, B Limited is purchasing the product from AINC at rupees 700. Whereas B Limited could have purchased similar product at, say, rupees 500 from, let's say, XINC, which is an unrelated or a third party. So therefore, what B Limited is trying to do is, B Limited is trying to reduce its profits by claiming the excessive deduction. Isn't it? B Limited is doing that thing only. B Limited is purchasing at a higher price when it could have purchased at a lower price. And therefore, it is reducing its profits. And that is why we have a principle called as arm's length pricing. So what does arm's length pricing do? Arm's length pricing is the price between the unrelated parties of a similar good or services. And we will adopt that pricing for the purpose of this particular product. So for this product, we will not take rupees 700, but we will take the arm's length price of rupees 500. And accordingly, we will compute the profit. Are you getting that thing? So that is how the arm's length principle works. Now, this arm's length principle has not come from Indian perspective only. It's not present only in India. This is present internationally because this was developed by OECD. So this principle is not just restricted to India. Across the globe, countries are following the arm's length principle to curb the pricing between the, or to curb the profit shifting through the pricing between the companies or the pricing in the intercompany transaction. Because the companies then try to shift the profit from one country to another country. So arm's length price is the price that would be paid if the comparable transaction would have been taking place with the independent and unrelated parties. So what happens in the related party situation? They can manipulate the pricing. So therefore, the similar kind of good, if I would have purchased from the unrelated party or an independent enterprise, then what would have been the pricing? That would be my arm's length price. Now you will ask me, ma'am, how do we calculate the arm's length price? For that, we will go into detail. There are guidelines given. There are methods given to calculate the arm's length price. But first of all, let's understand that this arm's length price is a kind of specific anti-avoidance regulation. So therefore, this arm's length price is the transfer price. So this is my transfer price, right? This is the transfer price, which is the price between the associated enterprises. And I'm substituting my transfer price with the arm's length price. Are we getting that? So that we have a parity between the pricing of the associated enterprise and that of the independent enterprise, and that there is no advantage is given to the associated enterprises. And we can know what are the real taxable profits, because otherwise, if I allow the transfer prices to be there without substituting with the arm's length price, then what will happen is the taxable profits or my total income will be a distorted figure, because it's a manipulated price which has been taken into consideration. So in order to determine the real taxable profit, we have to take into consideration the arm's length price. Is that clear? Is that clear? But there are certain disadvantages also of the arm's length principle. What are the disadvantages? You would say, okay, we have now transfer pricing, we have the arm's length principle, but what is the real disadvantage in this case? So understand very carefully. In the transfer pricing, we are substituting arm's length principle. But understand that you cannot even compare the twin children. All right? Can you compare them? Are they exactly comparable with each other? The answer is no. They are not comparable. No individual is comparable to another individual. So how could you even compare the entities? How would I say that this particular product here, which is at 500, is comparable to 700? It may not be. But what we are trying to find out here is that at least we get to a comparable where there are minor differences which will not have the major impact on the pricing. So you could compare the cost of red apples with the green apples, but you cannot compare the cost of apples and oranges. Are you understanding? But there are sometimes products which are developed by a specific company, which may not be available with some other company. For example, there could be a major breakthrough innovation which has been developed by only one company at the moment, which may not be available, or which may be that company might be having a monopoly in that particular product. So therefore, in case of these innovative products, or a company, say for example, has an intangible, has some brand attached to it, because of which it cannot be compared with the products which do not have that value to their brand. Are you understanding? So in those cases, it may be very difficult to obtain a comparable. So the comparable might be difficult to obtain, and therefore, in that situation, arm's length pricing may not be a correct option to find out the comparable pricing. It can so happen, right? So the commercial relations between the associated enterprises and independent enterprises may not be same always. So there cannot be always a true comparison. It is also possible that since the associated enterprises are operating in a group, they have economies of scale. They are having much better benefits than I would have bought the same product from the third party. Quite possible. Say for example, there is my head office which purchases the product in bulk for all the group companies globally, and therefore it has a pricing advantage, and therefore it is able to sell to me at a very good price. I may not be able to fetch the similar price from a third party, because from a third party I am individually buying it, so it's not a true comparable, right? In that particular case, the arm's length pricing may not give a correct picture. Are you understanding? Any doubt till now? Any doubt? Any doubts? Did you understand this? Yes or no? Quickly in chat boxes. Okay. Also, as I said, sometimes there may be difficulty in getting the data, in getting the reliable information to apply the arm's length pricing. Because understand one thing, whenever I am comparing a transaction which I have undertaken with my associated enterprise, I need the data of the comparable transaction. And that transaction may not be easily available, because understand, how do you get that information? How do you find the comparables? How do you find the comparable pricing? It is available from the annual reports of the company. And this particular annual report may not be always easily available to you. or even if they are available, it might not easily reflect to you what is the particular transaction or how the transaction is priced, how the profits are computed. So therefore, the availability of data is the another problem of the arm's length principle. Are you getting that? So also there is quite a possibility that different companies have different accounting years being followed because of different jurisdiction. And therefore, it is also possible that the comparable pricing may not be easily available. Right? So therefore, these are some of the drawbacks of the arm's length principle. And therefore now, globally, the countries are trying to find out a different mechanism to tax the profits in the intercompany transaction. This is especially due to the fact that with the digital companies, we do not have the comparable pricing available because of the unique transactions being undertaken by these digital companies. So therefore, in that situation, the countries globally are trying to come up with a new principle for specifically these digital companies so that their profits can be correctly computed. Are you clear? So now, with respect to arm's length pricing, because we are to look into only arm's length pricing for the time being, we are not to look into what the countries globally are debating upon. Let's start with that. So for the applicability of the transfer pricing, I'll give you a checklist which you always have to remember. Any condition if failed, then the transfer pricing will not be applicable in that scenario. And what is the checklist? First and foremost thing, you need to see whether there is an associated enterprise. This is the first thing you need to check. If the answer is no, then straight away transfer pricing is not applicable. So there has to be the two associated enterprises. Clear? Second, if the answer is yes, you need to check whether there is an international transaction or deemed international transaction. We will see what is international transaction and what is deemed international transaction. We will see that. If the answer is no, transfer pricing is not applicable. Only if the answer is yes, you need to see whether it is at ALP. Whether it is at ALP. Or also write it over here, whether there is an international transaction, deemed international transaction, or specified domestic transaction greater than rupees 20 crores. So international transaction even from rupee 1 or deemed international transaction even from rupee 1 will attract transfer pricing, but specified domestic transaction greater than rupees 20 crores only will attract transfer pricing. We will see all of that. Right? Then you need to see whether it is at arm's length price. Right? If it is not, if the answer is no, then transfer pricing becomes applicable. If the answer to this is yes, the transaction is at arm's length price, transfer pricing may not be applicable, but you have to maintain the TP documentation. So even if your pricing is at arm's length price, you need to still maintain the transfer pricing documentation and plus there will always be transfer pricing assessment. Because how otherwise the assessing officer will know that whether you are saying it right or not? You are saying that it is at arm's length price, but assessing officer also need to know. He also need to agree with you. So you need to maintain the transfer pricing documentation, plus there could be the transfer pricing assessment too. Are we clear till now? Any doubts? So first thing you need to check is whether there is an associated enterprise. And secondly, we need to see whether there is an international transaction or specified domestic transaction. If yes, only then the transfer pricing will be applicable. Clear? Any doubt? Yes, Namita, you're correct. Digital companies like Amazon, you're very correct. Okay. So let's proceed further. Now, first of all, for the applicability of the transfer pricing, there is a charging section. Like we had done for every other head of income, there was a charging section. Even for the transfer pricing, we have a particular charging section. Transfer pricing is a code in itself. Remember that thing. It is a code in itself. Transfer pricing is a particular chapter under the Income Tax Act. Chapter 10. So the chapter 10 contains the entire provisions for the functioning of the transfer pricing. And the sections are section 92 to 92F under chapter 10 of the Income Tax Act. Now, let's try and understand the applicability of the transfer pricing. What is the applicability? So, section 92 is talking about the applicability of the transfer pricing. Section 92 talks about the applicability of the transfer pricing. Also remember one thing, as I said, it was introduced by the Finance Act of 2001. And the memorandum there clearly stated that memorandum to the finance bill basically explains the intent of introducing a provision. And what was the intent of introducing transfer pricing? It said it that with a view to provide the statutory framework for the reasonable, fair and equitable profits and tax of the multinational enterprises. The transfer pricing provisions are being introduced. So this was specifically introduced to curb the tax avoidance by the multinational enterprise, because they were able to allocate the profits in different jurisdictions by controlling the prices of the intra-group transaction. So that was the purpose with which transfer pricing provision was introduced by the Finance Act 2001. Right? And section 92 talks about the applicability of the transfer pricing. Now, what does section 92 provides? Let's try and understand. Applicability of the transfer pricing. What does it provide specifically is section 92(1). Section 92(1) says that any income arising from the international transaction shall be computed having regard to arm's length pricing. So what does section 92(1) says? It says that any income arising from the international transaction shall be computed having regard to the arm's length price. So any income, it also includes any allowance for expense, not just income, allowance for the expenses, interest from the international transaction shall be computed having regard to the arm's length prices. So not only income, but any expenditure also, or even the interest income or interest expense also, or interest income also, shall be determined on the basis of the arm's length price. Further, this is section 92(1). Section 92 subsection 2, it says that in case of the international transaction, in case of an international transaction or the specified domestic transaction, when there is, so in case of international transaction or specified domestic transaction where two or more associated enterprises AEs enter into a mutual agreement or arrangement for the allocation or apportionment of or contribution to any cost or expense incurred. In connection with a benefit or service or facility provided to one or more of enterprises. So what does this mean? Let's try and understand. 92(1) is the first general provision which says that any income arising from the international transaction shall be computed having regard to the arm's length pricing. So any income which is arising from an international transaction has to be computed in accordance with the arm's length pricing. This also includes any expenditure or the interest. Section 92(2), it says that when the associated enterprises, when the two associated enterprises, in case of when the two associated enterprises enter into a mutual agreement or an arrangement. So quite possible, say for example, Infosys has bought some software. Say it has bought some ERP. Now it is sharing that ERP across the companies, across the group companies globally. Now, when it is sharing the software across the group companies globally, it is charging the cost which it has paid to the vendor to the different companies. It is allocating the cost to the different companies, because why only it should bear? The holding company has bought that software which every group company can use. But what Infosys does is the holding company will allocate that cost to the different companies, different group companies based on some key, based on some allocable key, right? Or allocation key. So if the associated enterprises enter into such a mutual agreement or an arrangement for the allocation or apportionment of or contribution to any cost or expense in connection with any benefit, service, or a facility provided to any enterprise, then even that cost has to be determined having regard to the arm's length principle. So it is quite possible now the Infosys has allocated, say, based on some key. Now, it has allocated, say, 50 rupees to India, 1000 rupees to US, 1500 rupees to Singapore, based on some key. But it needs to be seen that that particular key which is used, or the distribution of an expense, or the allocation or apportionment of the expense, has been made as per the arm's length principle. It should not be the case that there is some random allocation. So it has also to be with regard to the arm's length principle. Are we clear? So that is section 92.2. That is section 92.2, right? And then section 92.2a. There is also section 92 subsection 2a. What does that say? That section says about the specified domestic transaction, SDT. And what does that say? It says that in case of the specified domestic transaction, in case of a specified domestic transaction, again the income, the expense, the interest also has to be computed having regard to the arm's length pricing. So 92.1 was the general one. Any income arising from international transaction has to be computed having regard to arm's length price. This also includes the expense or the interest. 92.2 is regarding the mutual agreement between the associated enterprises. So the cost which is allocated or apportioned between the associated enterprise, that also has to be with regard to the arm's length price. Section 92.2a. This is for any income, allowance for expense, interest from specified domestic transaction shall be computed having regard to ALP. Even for this, you can write it shall be computed having regard to ALP. Is that clear? So 92.1, 92.2 and 92.2a. Now 92.3. Section 92.3 talks about the non-applicability of the transfer pricing provision. So section 92.3 is the exception to 92.1, 2 and 2a. And what does that say? 92.3 says exception or non-applicability of transfer pricing. What does 92.3 says? That transfer pricing provisions or section 92.1, 2 or 2a shall not be applicable where adoption of ALP shall result in decrease in the taxable income, shall result in increase in the taxable income or increase the losses or increase the losses. What does this mean? Let's try and understand. Let's take an example. The earlier example only we took. This example. Right? Let's take this example only. Now, if you see in this example, here the price was give me a moment. Here my pricing is how much? One second. Here. Here my pricing is 700, right? Now, if my pricing here is 700, then in that case, let's assume now this is not 500. This is 700 and let's take this as 800. So what will happen in this scenario is that even if my purchase price is 700, now ALP is 800. Now if I substitute 700 with 800 rupees, what will happen? Understand very carefully. B Limited in its P&L would have claimed purchases of 700. Now, if it claims rupees 800, the profit will decrease by 100, right? Or if there would have been a loss, the loss would have increased by 100. This is not the intention of transfer pricing provision. Transfer pricing provision, as I said at the beginning, these are specific anti-abuse regulation. What does that mean? These are to prevent the tax avoidance. But if by applying the transfer pricing provision, the offered income is getting reduced or the offered loss is getting increased, then the TP provisions will not be applicable. This will only apply if the income offered is less than what it should have been offered. So had it been the ALP, had it been rupees 500, TP would have been applicable because my profits were shown at a lower rate, right? And by putting 500, my profits will increase. My deduction will reduce and my profit will increase, right? And therefore, in that case, only the transfer pricing will be applicable. Are we getting that? Any doubt? Any doubt till now? Did we understand? Yes or no? So transfer pricing will not apply if it has the effect of reducing the taxable income or increasing the loss. Are we clear? So this is about the applicability of the transfer pricing, right? Now, let's move to the first part. What is the first question we had to ask? Whether there is an associated enterprise. Now let's look at the meaning of the associated enterprise. Section 92A talks about the associated enterprises and deemed associated enterprises. 92A1 talks about the term associated enterprise. 92A1 talks about the term associated enterprises. How does it define it? 92A1 says that for the purpose of section 92, associated enterprise in relation to another enterprise means an enterprise which participates directly or indirectly or through intermediaries in management, control, capital of another enterprise. So, associated enterprise means an enterprise which participates directly or indirectly or through intermediaries in the management, control, or capital of the other enterprise. Right? Or it also includes an enterprise in respect of which one or more persons participate directly or indirectly or through intermediaries in its management, control, capital. Management, control or capital, and are the same person who participates directly or indirectly through one or more intermediaries in the management or control or capital of other enterprises. So, an enterprise in respect of which one or more person participates directly or intermediaries in its management, control or capital, and also in the other enterprise. So an enterprise in respect of which one or more person participates directly or indirectly or through intermediary in its, or you can write it like this, in its and in the other enterprise. So what does this mean? This one means the first part means that A and B are A's, or for that matter, A, B, C, all these are A's. Here this means A is participating in management, control or capital of B, is also participating in management, control or capital of C. Then all these three are associated enterprises. Are we clear? Are we clear? So this is 92A1, the definition of the associated enterprise. Now, if B Limited would have purchased at 700, then it is the same pricing. Then that is only the arm's length pricing, right? If it would have purchased at 700, then that's the same pricing. Then it's at arm's length price only, right? Now, what is deemed enterprises? Deemed associated enterprises. Let's try and understand. Now, this is the general definition: participation in management, control or capital. Deemed associated enterprise gives the extended 13 relationships to expand in 92A1. It gives certain deemed relationships wherein it will be deemed to be the associated enterprise. So what I'll be doing is, I'll be bifurcating the deemed relationship so that it's easier for you to remember. Income Tax Act has not bifurcated this way. It is, I am bifurcating it for you, basically for you to remember in your examination. So let's say capital-based relationships, control-based relationships, and finally management-based relationships. So I'm bifurcating into three categories: capital, control, and management. Let's first talk about the capital-based relationship. This bifurcation I am giving you, it's not present in Income Tax Act. So this is easier for you to remember. Number one, ownership. So any enterprise having direct or indirect ownership in shares greater than equal to 26% of voting power, that is deemed to be the associated enterprise. So 92A1 is not giving you any percentage. It is just saying management, control or capital. It's a general definition. 92A2 says that 26% if you are having, that is deemed to be the associated enterprise. So any enterprise having direct or indirect ownership in shares having greater than equal to 26% of voting power. So say for example, X Limited, it has say 43% stake in YINC. Both of them are associated enterprises, right? Second, under the capital based, mutual holding. So any enterprise or any person has direct or indirect ownership of shares having greater than equal to 26% of voting power in two or more enterprises. What does this mean? So what 92A said it in the second clause, this thing, it's the same thing put up with the 26% clause. It's the same thing put up under the 26% clause. And what does that say? It says that if AINC has say 25% stake, 27% stake in say X Limited and say 31% stake in Y Limited, then X and Y are A's. X and Y are basically A's. Are we clear? Is that clear? So that is the second relationship. Third, substantial lender. So loan advanced by an enterprise greater than equal to 51% of book value of assets of borrower. Now, what does this mean? Say, for example, X Limited. This is X Limited. It has, say, the assets worth rupees 150 CR. And it has taken loan from, say, Y Limited of, say, rupees 100 CR. Now, if you see the loan, which is 100 CR, is greater than 51% of 150 CR, book value of the assets. And therefore, X and Y are associated enterprises. Are we clear up till now? Are we clear? Let's proceed further. Next, under the capital-based relationship is holding in firm AOP BOI. So, enterprise holds greater than equal to 10% of interest in firm AOP or BOI. So say for example, X Limited holds say 15% in ABC partnership firm. So both of them are A's. Both of them are A's. Clear? So this is about the capital-based relationships. Now, under the control-based relationships, guarantor for borrowings. Guarantor for borrowings. So, an enterprise holds, or say, sorry, an enterprise guarantees, an enterprise guarantees greater than equal to 10% of total borrowings of other enterprise. Say for example, XINC and X Limited. X Limited has taken loan from say SBI of say rupees 1,000 lakhs. And XINC has given a guarantee of rupees 150 lakhs. So, since the guarantee is greater than 10% of the loan amount of X Limited, both of them become associated enterprises. Clear? Second, dependency on intangibles. So, an enterprise which is wholly dependent for its business on use of intangibles like patents, copyright, goodwill, intangibles owned by another enterprise or another enterprise has exclusive right to exploit it. Both of them will be A's. For example, Amazon India and Amazon US. Even if they would not have any intercompany, they would not have a holding subsidiary relationship. But Amazon India, say for example, is clearly dependent on Amazon US for its brand. Then in that case, both of them will become associated enterprise. For example, McDonald's franchisees which are operating in India, they may not have any holding company relationship, but McDonald's is clearly dependent on the brand name. The franchisees are clearly dependent on the brand name. So both of them will become associated enterprises. Clear? Third, supply dependency. So one enterprise is engaged in manufacturing or processing of goods and greater than equal to 90% of the raw material are supplied by other enterprise or supplied by person specified by other enterprise, and prices and condition of supply are specified by other enterprise. So say for example, the enterprise which is into the manufacturing or processing is buying more than 90% of their raw material from one enterprise. Or even if it is not buying from other enterprise, but if it is buying from a person specified by that other enterprise. So it could happen, say for example, there is X Limited, there is Y Limited, right? X Limited is buying the goods from Y Limited, both of them raw materials from Y Limited, more than 90% of raw material is sourced from Y Limited. Both of them will be associated enterprise, right? But if say for example, there is say A Limited. Now A Limited says that X Limited and Y Limited are there, and then there is A Limited. Now X Limited is buying from A Limited because Y Limited has said it that you have to buy these materials from A Limited. And the prices are determined by Y Limited only, plus the conditions for supply are also determined by Y Limited. So in that case, again, X and Y will be the associated enterprises. Is that clear? Clear? Next. Sale dependency. So where one enterprise is engaged in manufacturing or processing of goods, and such goods are sold to other enterprise or are sold to person specified by other enterprise, and prices and condition of sale are specified by other enterprise. For example, X Limited is there. It has entered into an agreement with Y Limited that whatever Y Limited will manufacture, it will sell to S Limited, right? So Y Limited does not work for any other company, and all of the products of Y Limited are sold to X Limited. Or for example, X Limited says that instead of selling it to me, you can directly sell to A Limited, and the pricing will be determined by X Limited only. So in that case, both of them will be associated enterprises. Is that clear? Next. Individual control. So when same individual or his relative controls two enterprises. For example, Mr. Mukesh Ambani controls RIL, controls Jio. Both of them are associated enterprises. What is the definition of control? control means individual, either himself or with his relatives, has power to make major decisions regarding management of both enterprises. Is that clear? So individual has the power to make the management decisions of both enterprises. And what is the definition of relative? Spouse, brother, sister, or lineal ascendant or descendant. Clear? Last one under control based, HUF control, where one enterprise is controlled. Again, the definition of control is same, by HUF, and the other enterprise is controlled by a member of HUF or relative of member. For example, ABHUF controls, say, X Limited, 28%, say, ownership, and Mr. A, who is Karta, and his brother has ownership of, say, 56% in B Limited. So both of them will be deemed A's. Is that clear? Any doubt till now? Okay. Next, management based. The last one is management based. Appointment of board. If one enterprise has power in relation to other enterprise of appointing greater than half of board members, or appointing one or more executive director. For example, A Limited has, say, 7 board members. A Limited has, say, 7 board of directors, including 2 executive directors. Now, say, for example, let's take an example. A Limited has 7 board members, including 2 executive directors, right? B Limited holds, say, 4%. B Limited holds only 4%. So by that way, they are not A's, right? But B Limited has the right to appoint 4 directors in the board of A Limited. It has a right to appoint 4 board of directors. And there is another company, say CINC, which is not holding anything in A Limited, but has a right to appoint one executive director. Then in that case, C Inc. as well as B Limited are AEs of A Limited. So C Inc. plus B Limited are A's of A Limited. Is that clear? Next, appointment of board in two or more entities. So where person has power with respect to two or more entities, appointing greater than half of board or one or more executive director. For example, Mr. Mukesh Ambani has the power to appoint 70% of the board of directors of RIL and RPL. So quite possible Mukesh Ambani has power to appoint 70% board of RIL and RPL. So RIL and RPL are A's. Is that clear? So this is about the deemed associated enterprise. Namita, ALP is 100. So you are saying if it had purchased at rupees 700, then in that case, we will not apply transfer pricing. That's what I said. So if the ALP is higher and if it results in reducing the profits or increasing the loss, then transfer pricing will not be applicable. Clear? Transaction of digital company are not comparable, Namita. Every company, Flipkart undertakes the transactions in a different way. It is not about what Flipkart is offering to its customer. It is about how Flipkart has the brand value, how Flipkart prices its transactions internally, which intangibles Flipkart has. All that is very different from Amazon. Both of them are very different. Both of them operate in a different model in the intercompany transaction. They may look similar to you from a customer perspective, but internally they have a lot of different transactions. They have different pricing, they have different investors, both have different valuations, so it is not at all comparable. Padmanabhan, what you have doubt, the first enterprise is having more than 26% in the second enterprise. The second enterprise is only having 25% in the third enterprise. Is the third enterprise a deemed associated enterprise of the first enterprise under 9282, as the second enterprise is only having 25% in the third enterprise? So you are saying under 9282 how it can be deemed A, because first enterprise has 26%, right? So both of them are A, but the second enterprise is not having is having lesser than 26% in the third enterprise. So third enterprise is not a deemed A of the first enterprise. Had it been both of them had been having this kind of percentage, then yes, they would have been A. Even indirectly, if you see, they are not A's because the 26% threshold is not crossed even in an indirect way, right? Any other doubt? Okay, so are we clear till now? Let's take a small break of 10 minutes. Let's take a small break. Okay. Namita, indirect participation in management point is not clear. You mean to say the last point? As I said in the last point, if say for example Mukesh Ambani has a right to appoint the management of board of directors of RIL as well as RPL, then in that case RIL and RPL both will be the associated enterprises. Hope it is clear now. Right? Shall we proceed further then? Okay. Let's proceed further. Now we will come to the next point of our discussion, which was whether there is an international or deemed international transaction. Let's try and understand what do we mean by international transaction or the deemed international transaction, right? So let's discuss that, the second point. Now that is defined under section 92B. Section 92B talks about international or deemed international transaction. Right? Now, first we are talking about international transaction, the generic one. Right? Now, what is international transaction? Let's try and understand. We did understand 92A, which is the associate enterprise, and now we are moving on to the 92B, which is international transaction. Now, international transaction means what? International transaction means a transaction between two or more A's, between two or more associated enterprises. So international transaction means a transaction between two or more associated enterprises, either or both of whom are non-residents. Either or both of whom are non-residents. This is very important. So either of the associated enterprises or both of them should be non-residents. A, we saw, was defined under 92A. What is the meaning of transaction? Transaction is defined under section 92F. What is the meaning of transaction under 92F? It means that agreement or understanding or action in concert, whether or not in writing or whether or not enforceable by legal proceeding. No need to learn this definition, just that I'm mentioning to you, it is defined under 92F. So what is international transaction? Is transaction between two or more associated enterprise, either of or both of whom are non-residents. And the nature of transaction should be what kind of transaction? Purchase, sale, lease of tangible or intangible property, provision of services, lending or borrowing of money, allocation or apportionment of or contribution to any cost or expense. So purchase, sale of tangible, intangible, leasing of property, provision of services, lending or borrowing of money, allocation or apportionment of contribution to any cost or expenditure, which is what we had even seen under 92, which was the applicability of transfer pricing. That any allocation or apportionment of cost also has to be as per the arm's length principle. Or any other international transaction having bearing on profits, income, losses, or assets of the enterprise. Is that clear? So this is the meaning of your international transaction. Sale, purchase, lease of tangible, intangible property, provision of service, borrowing or lending of money, any other transaction having bearing on profit, income, losses or assets of any enterprise, or mutual agreement for sharing of cost, apportionment or allocation of cost. Between these should be between the associated enterprise, either or both of whom should be non-resident. So this is the meaning of international transaction. Is that clear? Is that clear? Any doubt? Any doubt till now? Okay. Namita, participation through one or more intermediary means that, for example, A is there, then B is there, and then C is there, right? So A, B, C, all three would be, B is the intermediary, right? So A, B, C, all three would be the associated enterprise of each other if they have the participation more than 26%. Is that clear, Namita? Okay. Let's proceed further. Now, what is the meaning of deemed deemed international transaction? That is defined again under 92B2. That is defined under 92B. 1 was your international transaction. Now we are coming towards 92B2, which is deemed international transaction. Now, what does that mean? Let's try and understand. Let's try and understand this one. So 92B2 says that we will understand this with the help of an example. Say, for example, there is A Limited. There is A Limited and there is B Limited. Both of them are unrelated to each other. Both of them are unrelated to each other. But there has been an agreement for sale. There has been agreement entered into for sale of product. There has been an agreement between both for sale of a product. Say on 1st of June 21, they have entered into an agreement. Now, simultaneously, if you notice, prior to this agreement, B Limited had entered into agreement with C Limited, which is AE of A Limited. Now, B Limited on say 30th May 2021, prior to this agreement, had entered into an agreement with C Limited, which is the AE of A Limited, for agreement for sale of product purchased from A. So C Limited, instead of directly purchasing the product from A Limited, is purchasing the product from B Limited, and then B Limited is purchasing it from A Limited. What could be the reason? The reason is simple. If they interpose B Limited in between, what will happen? There will be no transfer pricing because A and B are unrelated to each other. There is no associated enterprise. And again, between B and C, there will not be any transfer pricing because both of them are unrelated to each other. For transfer pricing applicability, one of them should be AE of another. Here, there is no question of AE. Both are unrelated enterprises. So, in this case, what do they say is, they say is that A Limited and the transaction between them, between A and B, is deemed to be an international transaction, whether or not B is a non-resident. So this transaction is deemed to be international transaction. So let's try and understand what is deemed international transaction. There is a person, or let's write there is an unrelated person who can be a non-resident or even a resident. Who can be a non-resident or even a resident. It has entered into prior agreement or terms of transaction are determined. There is an associated enterprise. There are the associated enterprise. One of them should be non-resident, right? One of them should be a non-resident. So if there is existing a prior agreement, this is a prior agreement here, right? Isn't it? This is your prior agreement between an unrelated party and AE. Then in that case, this will be deemed international transaction. This will be your deemed international transaction. Is that clear? Whether or not Mr. B or B Limited is a non-resident. Any doubt? Are we clear about this? So this is the meaning of the deemed international transaction. Clear? Any doubts? Any doubt? Okay, let's proceed further. Now, as I said, what does 92B says is that transaction between two or more associated enterprises, either or both of whom are non-resident. What is the definition of associated enterprise? Associated enterprise or the deemed associated enterprise says that an enterprise which participates directly or indirectly. Now, understand one thing. The term enterprise is also defined. The term enterprise is also defined term. Now, this term is defined specifically under the Income Tax Act under Section 92F. This term includes permanent establishment, P. Enterprise is defined to mean a person including its PE who is or has been engaged in any activity relating to production, storage, supply, provision of services, providing loans, business of acquiring, holding, all of that. But what is important is that the term enterprise includes a term PE. PE means what? PE means a fixed place of business through which the business of the enterprise is carried out. PE means, PE is also defined, which means fixed place of business through which business of enterprise is carried on. You can understand PE means basically a branch of a foreign company. Now the question to you is, understand this very carefully. It could be part of your MCQ also. Question is that transaction between, say, A Limited, which is Indian company, and its branch in, say, US, which is a PE, whether this will be subject to transfer pricing. Whether this will be subject to transfer pricing. The answer is no. This could be part of your MCQ or even a small case study. This will not be subject to transfer pricing. Can anybody give me the reason for this? Anyone? Let me see if anybody is able to give me the reason why it is not subject to transfer pricing. Let me see if anybody can give me the answer. Yes, Namita. Yes, very good. Very correct. So, understand one thing. What did I say at the first place? That for transfer pricing applicability, there should be international transaction between A's, either of whom or both should be non-resident. There is an international transaction. So this is satisfied. Whether they are A's, yes, they are. A's means enterprise having direct or indirect control, capital or management, right? They have the interest of control, capital, or management. So yes, they are AEs too. An enterprise includes a PE also, right? Either or both of them should be non-resident. Now, Indian company is a resident. The branch of the Indian company, though it can be treated as an enterprise, but it is also a resident because the branch is part of the company only. It is not a subsidiary. It is a branch. Branch is the part of the company only. So it is not a separate entity, though it is included in the definition of enterprise, but this is not a separate assessee. Assessee is whom? Indian company. Branch is not an assessee. Branch is not separate from Indian company. So therefore, even the branch is the Indian resident. And if branch is the Indian resident, there is no non-resident. And therefore, transfer pricing will not be applicable. Is that clear? So the transaction between the Indian company and its foreign branch will not be an international transaction. Is that clear? Also, since Indian companies' global income is going to be taxed in India, there is no question of tax avoidance. There is no question of tax avoidance, right? So therefore, this will not be covered by transfer pricing. But say, for example, let's take a reverse scenario. Say, for example, there is XINC, which is a US company. This has an Indian branch, which is a P. In this case, this is an enterprise. They are A's. Plus there is international transaction. Plus both of them are non-resident. So therefore, in this case, transfer pricing will be applicable. So in a reverse scenario where there is a US company having Indian branch, in that case, the transfer pricing will be applicable. Right? Because Indian branch will be taxable in India in respect of its Indian operation, and any transaction between Indian branch and its foreign company, or for even that matter, say for example, it has also branch in say Netherlands. So even this is enterprise. These and these are also A's. So between all three, it will be there. The transfer pricing will be applicable. Is that clear? Because in this case, there could be tax avoidance because the country is outside India. The head office or the Netherlands branch is outside India. In the first case, the Indian branch, foreign branch was part of the Indian company only, and Indian company's global income will be offered to tax, whether earned in India or outside India, right? So in the first case, there was no question of tax avoidance. But in the second case, yes, there could be tax avoidance. Are we clear? Any doubt? Yes, Namita, correct. Any doubt? Okay. Shall we move further then? Are we clear? Any doubt till now? Shall we proceed further? Okay. Let's proceed further then. Now we are turning towards the third kind of transaction, which is specified domestic transaction. So we had seen that in the applicability of transfer pricing under section 92 2A, right? If you see 92 2A, 92 2A was specifically with respect to the specified domestic transactions, right? Income, allowance for expense or interest from specified domestic transactions shall be computed having regard to ALP. So 92.1 was international transaction. This was mutual agreement or arrangement 92.2, and 92.2A was SDTs. Also, if you remember, we had done here whether there is an international or deemed international transaction or SDT. So we have done international and deemed international. Now we are moving towards the specified domestic transaction, the third part. Now, what do we understand by the specified domestic transaction? What is this? So, section 92BA covers specified domestic transaction. Section 92B was international transaction or deemed international transaction. 92BA is specified domestic transaction. Right? Now, what does the specified domestic transaction shall mean? Let's try and understand. Now, under the specified domestic transaction, we have the coverage of these cases. Undertakings, claiming profit linked deduction. First is inter-unit transfer of goods or services under section 80 IA 8. Under section 80 IA 8. First, write it down. I will explain you each and everything, right? So, transfer of goods, inter-unit transfer of goods or services, where the consideration for transfer does not correspond with the market value of goods and services under 80 IA 8. Then next is transaction with entities having close connection and generating more than ordinary profits. Section 80 IA 10. I will explain each and everything, so do not worry. Third one is transaction to which section 80A, chapter 6A, section 10AA or 35 AD applies, right? And the second part is any business transacted between a company opting for section 115 BAB and person with whom company has close connection. Let's try and understand. What does this mean? One by one. So, this particular, okay, one more thing before we start discussing about it. Here, the aggregate value of transaction exceeds rupees 20 crores. Now let's try and understand each and everything in detail. What do they say? With respect to the specified domestic transaction, which is under 92BA, first and foremost is any transaction which is pertaining to the profit linked deduction. Now what happens? Understand this thing. Let's understand with the help of an example. Say for example, there is AB Limited. Now this has 2 units. Unit X and or say unit A and unit B. Right? It has 2 units. Now unit A is claiming the deduction under section 80 IA. Unit A is claiming the deduction under section 80 IA. What was section 80 IA? It was for infrastructure development. Right? We had seen that while we were dealing with chapter 6. Now this unit A transfers the goods at say rupees 120. This is a non-tax holiday undertaking. Right? So unit B is unit A is transferring goods to unit B at rupees 120. And it transfers say to unrelated parties at say rupees 80. So your 80 becomes the ALP, right? Now let's try and understand. So this is unit A, which is claiming the tax holiday undertaking, and your unit B is a non-tax holiday undertaking. Say for example, their income other than related party transaction is say rupees 100 and 250, right? income is how much? For A, it is going to be 120, right? A is selling the goods, so for A, it is income less related party expense. So for B, it will be expense since B is purchasing it, right? Other expenses, say 50 and 60, right? Profit of A is say 170 and profit of B is say 70. Now for A, the tax can be 0 and for B, say it is at 30%. So it will be 21, right? So what is happening over here is A, which is a tax holiday undertaking, even though it is offering this as income, but this income is entirely exempt, right? So even though it has 120 as the income, this income is exempt because we are under 80 IEA. This is a tax holiday undertaking. And by selling the goods to unit B at a higher price, 80 is your arm's length price, right? 80 is your ALP, but this unit has bought at 120. So it is claiming the higher deduction and therefore the profits are lower, right? And therefore the tax is also lower. So what is in actual happening is the profits are shifted, or rather the profits are shifted from non-tax holiday undertaking to holiday undertaking. Are you understanding this? The profits of unit B are being shifted to unit A because unit A is getting the tax holiday. This is also what happens in the international transaction. The profits from one country are shifted to another country by claiming excessive deduction, where the tax rate is high and the profits are shifted to low tax country. Similarly, even in the domestic situation, if one unit is claiming tax holiday, another unit is not claiming the tax holiday, then from the non-tax holiday undertaking, the profits are being shifted. And therefore, there is a provision of the specific rule, which is the specified domestic transaction. So, under 80 IA 8, 80 IA subsection 8, it says that where any goods or services of the eligible business for which the deduction is being claimed are transferred to any other business carried on by the assessee, or where goods or services held for the purposes of any other business are transferred to eligible business in a vice versa situation, the consideration is not same to the market value. Then there will be the transfer pricing applicability, the specified domestic transaction. So in that case, there will be the specified domestic transaction and it will be subject to the arm's length pricing. But the value of that transaction should be more than rupees 20 crores. If it is less than 20 crores, transfer pricing will not be applicable, but still 80 IA 8 says market value will be applicable. So arm's length price will not be there. Arm's length price is different from market value. Arm's length price has to be computed with the transfer pricing methods. ATIA 8 says that still, even if, say, for example, if the value of transaction is, say, only 2 crores, then in that case, the pricing will be as per the market value. That is as per ATIA 8. But if it is more than 20 CR, then only specified domestic transaction it will be categorized as. And in that case, the arm's length pricing will be substituted. Is that clear? Is that clear? Are we clear about this? So the first was ATIA 8 in this case, right? That's what we learned. So under the profit link deduction, inter-unit transfer of goods or services under ATIA 8. There is also ATIA 10. There is ATIA 10, ATIA again under section 10. What do they say is that ATIA 8 is about the inter-unit transfer of goods or services where they do not correspond to the market value. But under ATIA 10, this is where it appears to the AO owing to the close connection between the assessee carrying on the eligible infrastructure business and any other person. If in the opinion of the AO, ATIA 10 applies only when the AO examines it. So when the AO is of the opinion that the business between the unit, eligible unit, and the other person is arranged in a way that the profits are being shifted from the non-tax holiday undertaking to the tax holiday undertaking, then the AO can redetermine the profits. Then the AO can redetermine the profits as per the arm's length principle. So under ATIA 8 or ATIA 10, more or less both are similar, but ATIA 10 is from the AO's perspective and AO will examine the transaction. And finally, transaction to which section 88, chapter 6A, 10AA or 35AD apply. All of these are profit linked deductions only, right? All of this are profit linked deduction only. Under 10AA, 10AA also you get the profit linked deduction for SEZ units. Under 35AD also we have different set of deduction, right? Similarly, in the chapter 6A, there are different section ATIA-C, ATI, ATIA, ATIB. There are so many different profit link deduction, right? And specifically under ATA also, it has been said that where any goods or services of the eligible business are transferred to any other person or any other business to non-eligible undertaking, and if the transfer is not corresponding to the market value, then it will be subject to the specified domestic transaction. Is that clear? So in the case of inter-unit transfers under ATIA or under any other chapter 6A deduction, 10AA, 35AD, ATIA 10, then in that case, it will be subject to specified domestic transaction. It will be categorized as specified domestic transaction if the aggregate value is more than 20 CR. The second limb of specified domestic transaction is any business transacted between a company opting for 115 BAB. Do you remember 115 BAB? We have under 115 BAB a specific tax rate of 15%, right? A lower tax rate. And we had seen that under 115 BAB also, if the AO is of the opinion that owing to the close connection between a person, between a company to whom 115 BAB is applicable and any other person, and their affairs are arranged in such a manner that the profits are shifted from the other company to 115 BAB company, then in that case, transfer pricing will be applicable. It will be a specified domestic transaction. Is that clear? Any doubts till now? Any questions? Any doubts? Any doubts? So specified domestic transaction will be applicable only if the value of the transaction exceeds rupees 20 CR. Is that clear? Is that clear? Also, remember one more thing. Again, specified domestic transaction will not be applicable if it has the effect of reducing the taxable income or increasing the losses. Same as international transaction. Is that clear? Is that clear? Any doubt? Any doubt? Okay, let's proceed further then. Let's proceed further. Hello. My screen is visible now. Okay. Yes, sorry students. Yes, Namita, you have a question, ma'am. In 115 BAB, it is said that AO can levy highest tax rate. It is not written that the transfer pricing provisions will be applicable. Namita, if you read 115 BAB, clause 6, it says that where it appears to the AO that because of the close connection between the person or between the company to whom 115 BAB is applicable and any other person, and the course of business is arranged in such a way between them that the 115 BAB company produces more than ordinary profits which might be expected to arise in such a business, then the AO shall compute the profit based on the reasonable profits that should be derived. It is not written that it can apply the highest tax rate. It says that, and the arrangement will be determined based on the arm's length pricing. So 115 BAB says like that. Are we clear? Pranav, the lecture has started again. There was some technical glitch. Okay. So that is about international, deemed international and specified domestic transaction. Now we are proceeding towards the arm's length principle, which is the fourth part. We have covered A, we have covered international, deemed international transaction, we have covered specified domestic transaction, and now we are moving towards the arm's length pricing, computation of the arm's length price. Are we clear? That is the fourth part, right? In our checklist also, that's what we saw. Now, what is arm's length price? Again, arm's length price is defined under section 92F. This is defined to mean price which is applied or proposed to be applied in a transaction between unrelated persons in uncontrolled situations. So what does 92F says? It says the price which is applied in a transaction between the unrelated persons in the uncontrolled situation. So the situations which are not controlled by the associated enterprises. So this is defined under 92F. Is that clear? And what did section 92 say? 92 said that the income from international transaction shall be computed having regard to arm's length price. And this is what arm's length price means. So the income from international transaction has to be as per the arm's length price. Now, what is arm's length price? Arm's length price is the price between the independent parties for a similar or a comparable transaction. Right? So ALP is nothing but a benchmark price which is between the unrelated enterprise in a comparable situation. Section 92C gives you the methods of determining the arm's length price. So the transfer pricing methods can be categorized into three parts. First is traditional, transactional, and other. Traditional methods, transactional profit methods, and other methods. In this, we have CUP method, which is called as comparable uncontrolled price method. Second is resale price method. Third is cost plus method. Under the transactional profit method, we have transactional net margin method and profit split method. And other methods, they can be prescribed by the CBDT, which could be based on the valuation reports. So that is other method where these methods cannot be applied. Now we will be today doing one method. We'll be starting with one method, which is the comparable uncontrolled price method, the CUP method. But before that, which method you should select? So section 92C tells you that section 92C tells you that the arm's length price in relation to international or specified domestic transaction shall be determined by any of the methods. It is not that you have to go sequentially. It can be any of the methods being the most appropriate method. So you need to determine by yourself the most appropriate method. And how will you determine the most appropriate method? Based on based on the nature of transaction, based on the nature of the transaction or nature of associated enterprises, based on the functions performed by the A. So based on the transaction, based on the A's, based on the function performed by A's, you will determine the most appropriate method for your transaction. Is that clear? So based on all these things, the most appropriate method will be determined for your transaction. Are we clear? Are we clear till now? Any doubt? Perfect, Namita. So based on your nature of the transaction, you will know that what is the particular transaction, who are the associated enterprise, and for that purpose, you will determine which is the most appropriate method out of these. Clear? And as I said, we have the three categories of the method. We have the three methods, three categories basically, and within the three categories, you have to choose. Clear? Any doubt? Any doubt? Okay. Now understand one thing very carefully. First, we are talking about the CUP method. First, we will talk about the CUP method. And for that purpose, Rule 10b also gives us the guidance. How do we apply? So Section 92C only gives you the methods. Section 92C only gives you the method. And Rule 10b gives you the guidance as to how do we apply these methods. So Rule 10b gives guidance for applying the method, or rather I would say the most appropriate method. And how do we choose the most appropriate method? Based on the nature of the transaction, international transaction or the domestic transaction, specified domestic transaction, based on the associated enterprises, the functions associated enterprises are performing. So for the selection of the most appropriate method, what you need to see is, for that, Rule 10C gives you the guidance. How do you select the most appropriate method? Based on the nature of international transaction or specified domestic transaction, based on the functions performed by A, assets employed by A, and risk undertaken by A. This is called as FAR analysis. We will talk about it. Functions, assets, and risk. Functions performed by A, risk employed, assumed by the A, and the assets employed by the A. Based on availability of data of comparables. So you also need to have the data available, right? For applying a particular method. Based on the availability of data, availability or reliability of data. Based on the degree of comparability between the international transaction and the uncontrolled transaction. Between the international transaction or SDT and uncontrolled transaction. Based on the adjustments which can be made to be made for the differences between uncontrolled transaction and controlled transaction. So if there are any differences, if both of them are not comparable, so we need to make the adjustments to make them comparable. So based on the adjustments that can be made. Based on the assumptions which can be made. So you need to also make certain assumptions while applying a method. So based on all this, you will have to determine the most appropriate method. Based on the nature of transaction, based on the functions performed, assets employed, risk undertaken by AE, based on the adjustments required, based on the availability of data, based on the comparability which is there between the international transaction and the uncontrolled transaction. Based on all these, you will select your most appropriate method. Are we clear? Now, as I said, first method is the cup method. Comparable uncontrolled price. Cup method. Now, as the name suggests, Namita, I just now said what are the factors we need to consider to select the most appropriate method. I just now wrote it down, right? Now, as the name suggests, comparable uncontrolled price method. Let me give you an example to understand this. So, say for example, there is AB Limited. There is a company AB Limited, right? Now, this company AB Limited is a subsidiary of the US company, say AB Inc. Right? Now, this AB Limited, which is there, the US company is selling the laptops to the Indian company. The US company is selling the laptops to the Indian company. So, there is a sale of laptops from the US company to the Indian company. Right? How many laptops are sold? Say 50,000 laptops are being sold by the US company to the Indian company. And at what price are they being sold? At 11,000 per unit. $11,000 per laptop. Right? Now, in this case, if you see, the US company is selling the laptops to the Indian company. The US company is selling the laptops to the Indian company. The US company is making the similar sale. The US company is selling the similar thing to, say, X Inc, which is an unrelated company, at, say, rupees 10,000. So what I am comparing here is the price of the laptop sold to an unrelated party versus the price of the laptop sold to a related party. So AB Limited is purchasing the laptops at 11,000, whereas the arm's length price is 10,000. So I will take into consideration 10,000 and not 11,000. So first and foremost thing, under the cup method, we have to identify the price charge for similar goods or services provided in comparable uncontrolled transaction. So what we are comparing here is the price for similar goods or services. Now, quite possible here the laptop sold is, say, Dell, and here we have Apple MacBook. You will say both of them are not at all comparable. but at least we have a similar price band. We need to make, of course, here adjustments. If we find out instead of Apple, we have Dell laptop comparable, that is the best comparable we have. But if we have Apple as a comparable, it is not totally comparable because Apple comes in a very premium segment where the Dell laptops are priced at say rupees 10,000 or 20,000. Apple would be priced above 60,000, 70,000. So there is a premium attached to the Apple products. So both of them are not comparable. But if instead of Dell, it is HP laptop, they are comparable to each other. They are similar. They are not same goods, but they are similar goods. So we can take the HP pricing. Now understand one thing very carefully. It is quite possible that in the first case where the US company is selling the goods to the Indian company, the US company which is selling the goods to the Indian company is not providing any warranty. However, when the US company is selling the goods to the third party, which is XINC, in that case, it is providing 3 months warranty. So in this case, there is, say for example, 3 months warranty given, which in this case, there is no warranty. So obviously because of warranty, the price would be little higher. So this is not comparable. This price 10,000 is not comparable to 11,000 because 11,000 is without warranty. 10,000 is with warranty. So both of them are not comparable price. So what is the warranty price? Warranty price is say 1,000. Warranty price is say 1,000. So say warranty price is 1,000. Right? So what we will be doing is, this is 1,000 say per annum. So what we will be doing is, we need to make adjustments in the price for the warranty charges. So the 10,000 price which is existing, sale price to XINC, which is 10K, less warranty charges, which is 1,000 into 3 months comes to 250. This will be reduced because we are not providing warranty to the Indian company. So therefore, your arm's length price will be 9,750. And you have charged 11,000. So 1,250 is the additional price paid by the Indian company multiplied by 50,000 units. That will be the addition made to the Indian company's books, to the Indian company's total income. Are we clear? To the Indian company's total income. It is also possible, say for example, understand this thing very carefully now. It is also possible that, say the US company which has sold 50,000 laptops to the Indian company has given a volume discount for the bulk purchase. So quite possible here there is a volume discount given on bulk purchase, say at the rate of 10%. Right? And here there is no volume discount. Here there is no volume discount, right? So in that case, we also need to make the adjustment for the volume discount. How will you make adjustment? Say for example, had this volume discount been given even to X, then at the rate of 10% of 10,000, it would have been 1,000. So 8750 in that case will be your ALP. Are we clear? So had we give the similar discount to the X Limited also, in that case, you will get the same, you will make the adjustment for the same volume discount to arrive at the ALP. Are we clear? Similarly, if the cost of this 11,000 is say freight on board cost, and this is a CIF cost which includes insurance and freight. So you will reduce the insurance and freight charges to arrive at the freight on board cost. So these kind of adjustments you need to make while computing the ALP. Is that clear? So in this particular method, what we are comparing is the pricing in a comparable transaction. So this method is ideally suitable for transfer of goods or provision of services. In these cases, this method is suitable. It's a very direct method. What we are comparing here is the pricing. Are we clear? Also understand one thing very carefully now, before we close the session. The comparables in this case, we were seeing the comparable of the AB INC selling to X INC. So this is an internal comparable. What do we mean by internal comparable? Where the AB is selling to the internally, we have a comparable when the associated enterprises are doing the transaction with unrelated party. Similarly, the independent enterprise by the associated enterprise, right? There could be so say for example, this is at 10,000. The transaction of the laptops between them, between AB INC and AB Limited is say at 10,000. Same, this is Dell laptop, say this is HP laptop. Now this is an external comparable because none of the associated enterprises are selling or purchasing from third party. This is a third enterprise itself which we are looking into, and its transaction with its AE or its transaction with any other third person. Say for example, this is Infosys, and Infosys is comparing the transactions of Wipro. Quite possible. This is Dell, this is HP. So that is an external comparable. So we can use internal as well as external comparables. Are we clear up till now? Any doubt? Any doubt do you have? Namita, why will not US company give data of its sale? These both are associated enterprise only. If there is no data available of sales because it is located in a foreign country, we are not able to identify or understand from their balance sheets, data is not available, then we can also take the Indian comparable. This was just as an example. Mostly we will take it as an Indian comparable only, from where the XY Limited will purchase, because that is easily identifiable. Any other doubt, any question? Is that clear? Okay, perfect, Naveen. So what I want you to do is, before the next class, go through the questions of cup from your module, so that in the next class, if you have any doubts, you could ask me. And the next class, we will be proceeding towards the other method, which is RPM, CPM, TNMM, and PSM. Is that clear? So if there are no further doubts, we can just close the session for today and we'll meet next class directly. Okay, Namita, you have Infosys example is not clear. So Namita, what I was saying is that there could be internal cup, there could be external cup. External cup is, let's say for example, say Infosys is, say this is Infosys. This is Infosys India and it has a subsidiary in Infosys US. Now, if Infosys India does a transaction with a third party, that is an internal cup, but or internal comparable. But if, say, for example, we take Wipro US doing with transaction with Wipro India, and we are taking that as comparable, then this is an external comparable. Are you clear, Namita, now? Namita, the screen sharing is on only. Let me do it again. So I said this is the internal comparable and this is the external comparable. Namita, I guess there's some technical glitch on Zoom, because of which I think screen share was not visible. But any which ways, what I was trying to say is that internal cup is that when the associated enterprise is itself transacting with another enterprise, so that is internal. If external, we will take a third company. That is what example I gave, that if Infosys want to use a comparable, it could use the transaction between Wipro US and Wipro India also. That is an external cup. I hope it is clear now. Okay, so we close the session now. Thank you so much.